What's up, everybody? Welcome to Heresy Financial and welcome to 2021. I've got some big things in store for you this year, and it looks like the market has some great things in store for us this year as well. As we're getting launched into the new year with markets trading, it looks like gold is starting off the year with a bang. Looks like it's getting set up for a fantastic 2021. Same thing with silver, same thing with gold miners, and obviously over the past week or so, 2 weeks or so, we've had a fantastic rise in Bitcoin as well, and so looks like some great things are happening for the hodlers and the godlers. Godlers? Is that a thing? Probably not. In either case, though, in this video, we are going to look at 10 things that we can expect to look forward to, 10 things that I'm expecting to see happen at some point during 2021, some point during this next year. Now, with everything that happens in the markets, it's good for some people and bad for others, depending on which way you're investing to prepare for it. And so some of these things might be considered kind of objectively bad things, but I'm saying things to look forward to because if you expect that they're coming, you can invest accordingly. Ready? Let's dive in. The first thing that I would like to say is thank you so much to all my new subscribers over the last couple of days. Got past 20,000 subscribers, and so really appreciate everybody who's been along since the beginning and all the new subscribers as well. Thanks for jumping on the train, and I'm truly expecting a fantastic and exciting year. Got some great things in store. The first thing that is up on my list on things to expect to come in 2021 is that this will be the year that inflation really starts to take off. Now, I know as soon as I say that, there are a ton of people that instantly the thing you think of in your mind is that's what everybody has been saying for years. All this money printing has been happening for decades and we've never seen inflation. And why are you so sure that it's going to happen now? And of course, a broken clock is right twice a day, right? That's what, the classic response to everybody who says inflation is coming. A couple things to note. Number one, I'm not looking at the official CPI numbers. I could care less actually if the official CPI numbers show that there's inflation. We know that the CPI understates intentionally what inflation really is because of a couple reasons. Number one, back in the 80s, the CPI calculation, it was changed in order to, slow, I think it was 1980 was the year that it was intentionally changed in order to reduce the amount of inflation that was being reported. Coincidentally, that was the year in which the high inflation of the 70s got under control. Kind of weird. Now, if you look at if you look at inflation today with the same measurements that they used prior to those changes, inflation has been running in between 5 and 10% ever since. You can look at shadowstats.com. This is a private source that calculates what inflation would be stated at if they were still using the pre-1980 metrics. Some of the changes that were involved, if you get a cell phone and it has, your new iPhone has better, computing power, better processing power, more features on it, well, then what that is going to do is that they're saying, hey, you're getting more for your money. And so even though the cost of cell phones and iPhones is going up, every year they get a little bit more expensive. Overall, the computing power has increased so much, the processing power has increased so much, the memory has increased so much that that is being calculated as deflation in the index. Doesn't matter that the actual cost of the unit, like the iPhone or the laptop or the tablet, is actually still going up. Another change that they made was the substitution method. And so let's say steak gets too expensive, so people start buying more chicken instead of steak. That means that in the index, they will use the price of chicken in place of the price of steak. And ultimately, that's not any more measuring anymore the cost of living, going up or down. What that's ultimately measuring is kind of like the cost of survival. It's not a true representation of the general level of prices. And so there's other changes that they made as well. But if you're just going back to what it was before, looks like inflation would be calculated. The CPI would be anywhere between 5 and 10% for the last, couple of decades. This isn't the only source that has alternate inflation numbers. Another one would be the Chapwood Index. And this one is a proprietary index. What they did was they looked at different cities. So they do the inflation by cities. They look at the most commonly purchased items in those cities. They track the price increases, and it looks like depending on the city, again, anywhere in between, 5 to 8% to up to 10 to 12%, depending on the city for the last, 5-10 years. So the reason why I'm bringing this up is because number one, I'm saying that inflation is going to happen a lot this year. We're going to see a lot of inflation. Number two, I don't think it's going to show up in the CPI because I think the CPI is designed in a way where you're not going to see that intentionally. And then number three is because Americans are used to a very high level of inflation. Inflation above 2 or 3% would have wrecked economies prior to really 1913, this last 100 years. If you read Reinhard and Rogoff's book, This Time is Different, looks at the last 800 years. Really in the last 100 years is when the world has shifted to where you need to register much higher levels of inflation for economies to be wrecked the way they were before, when people were used to sound money. But for especially for the last couple of decades, especially in America, people are very used to inflation. And so you're going to need to see much more than 10% inflation for people to say, hey, I need to dump my dollars and buy whatever I can as fast as I can so that I don't lose purchasing power, because nobody recognizes that it's happening right now, whether it's at the grocery store, cars, or whatever it is. And I think this year we're going to start to see that, especially in isolated areas. You start to see, like in commodities, raw materials, you're in lumber, you're starting to see some of these, the things go up in price that contribute to the prices of the end products, the end services. You're seeing anecdotal data come out everywhere where companies are having to raise their prices because their suppliers are raising prices on them. And so I think this is going to start to come out really strong, where you're going to have large corporations start to recognize this and raise their prices across the board as well. Now, this leads into the second thing, which I think we're going to see this year, which is yield curve control. Now, one of the reasons why interest rates are so low is because the official inflation numbers are so low. And so if you expect that the cost of living is not actually going to be going up, you're going to be willing to lend at lower rates. But if you expect that those dollars are declining in value, which is the other way of saying that costs are going up, then you're going to demand a higher interest rate on that money to compensate for the value that those dollars are losing every year. And so in a low inflation environment, low rates are acceptable by lenders. The problem is when you get into an environment where inflation starts to spike, well, lenders aren't going to lend anymore unless they can charge a much higher interest rate, because if they can't charge a higher interest rate, then they're not going to lend. Otherwise, the money they're getting back when they get paid back won't go as far as it would before. And so in order to compensate themselves for that inflation, they will demand a higher interest rate. Well, we know that our economy is completely insolvent. There is far too much debt to be paid back even at zero interest rates. Whether you look at the actual economy, the private economy, or you look at public debt, like the federal government's debt, it doesn't matter how you slice it. When you look at debt to GDP, whether you look at total debt or just public debt, America is insolvent. There is not a possibility for enough income to come in to lower that debt load. Now, debt servicing costs right now are low, and that's important because that keeps the ball rolling. But once debt servicing costs go up, which is another way of saying once interest rates go up and you can't continually roll over that debt anymore, the economy grinds to a halt. Now, the solution that will be implemented by our policymakers is yield curve control. So any private market rates that spike, those parts of the credit industry, those parts of lending will be absorbed and taken over and nationalized by the Fed. The Fed will, instead of becoming the lender of last resort, they'll buy up all existing debt to keep rates low and keep debt prices high in order to keep the ball rolling so that the economy doesn't grind to a halt under the burden of servicing too high debt costs. But they'll have to do this everywhere. So I expect we'll probably see some spikes in rates this year in different areas of the economy. And I expect that different facilities and services will be rolled out by the Federal Reserve in conjunction with the Treasury in order to absorb those shocks and get those rates smashed back down, and we'll just start to see yield curve control across the entire yield curve so that rates don't spike anywhere. And instead of the Fed being the lender of last resort, they'll be the lender to everything. Now, this leads into the third thing that I expect to happen this year, which is that the Federal Reserve basically just becomes the credit market, which actually crushes banks, because banks cannot survive. There is no profit potential left in real terms in our world. It crushes banks. The only way banks survive is if they're able to kind of go into austerity mode and jack up interest rates and be able to make some sort of profit off their lending. The amount that they lend goes down a lot, but they're able to make up somewhat for it by charging the higher rates. There's kind of a teeter-totter there, a trade-off there. The reason why lending needs to be so much right now is because rates are so low. So they're only making, this much off of every loan. They have to make a lot of loans. And so the opposite will happen. That's the only way banks can stay profitable. But if banks are profitable, that means that the economy collapses, right? And so the Federal Reserve and the Treasury, they're not going to let that happen. And so that means banks are insolvent. That means banks have to be absorbed, have to be, merged together and really nationalized and folded underneath the Federal Reserve. And this isn't part of, my 2021 expectations, but this could be part of a shift to a digital currency like a Fed coin or the new Treasury dollar here in the States. Now, more specifically, something that you can invest on would be commodities. And this is the fourth thing that I expect to happen this year, that we're going to have an absolutely fantastic year in commodities. I'm very, very bullish on commodities this year. And it's partly due to inflation and partly due to the momentum and the trends that we've been seeing start to come up. And also due to the supply chains. We're going to have big interruptions in trade deals all around the world. We're going to have big interruptions in supply chains like we had all for 2020. And so all of these make it more expensive to get your hands on the stuff you need to make stuff. And so I expect that prices for these will go up. You can invest that way. You can invest in, a diversified commodity ETF if you want to speculate on that. And I've made a video about commodity ETFs before, and a lot of you pointed out that if you look at the holdings in a lot of these commodity ETFs, they're mostly cash, and so or treasuries really is a lot of them. And the reason for that is not because they're actually holding cash. It's because the reason that these ETFs, the way they get exposure to the prices of commodities is through futures, and so they'll buy futures on lumber and copper and futures just by inherently their leverage. And so in order to hold enough capital so that the fund itself is not leveraged, you have to hold like 80 to 90% in cash or treasuries and only use a small portion for the futures. Otherwise, if you use everything in the fund and just buy futures, you're massively leveraged. The amount of cash in the fund is being deployed for returns or negative returns that are many multiples of what the actual cash in the portfolio is. And so futures on commodities, by the way, are not the same thing as like on gold, where there's multiple levels of hypothecation where you don't have the collateral to back up every contract. With commodities, due to the supply and due to the demand and due to the way that these markets work, they're pretty close. You're not going to run into a situation where the futures markets and commodities collapses while the actual price of the commodity skyrockets. Gold is kind of an outlier in this. Even silver doesn't have the same dynamics that gold has there. Now, speaking of silver and gold, this is the fifth and the sixth thing really that I expect to happen this year, that both gold and silver are going to be up big. I'm very bullish on both gold and silver right now for very different reasons. Number one, for gold, I'm very bullish, and I've made tons of videos about this recently, but because the gold trading desks are all going to have to be closing out all their naked shorts as the price continues to climb higher and moves into this new, removes back into the bull market that it's been in for years now, really since 2016. There's, a correction since August, but it looks like that's over now. As it removes back into that, their dollar losses keep on getting higher and higher and higher. And so they're going to have to continue to close those shorts out, which when you close shorts out, and that's buying pressure, that drives the price up. And so they're by far the biggest players in the gold space. And that will drive prices up, because if there's shorts out there, that means naked shorts is what these are. That means they can't be delivered. And as the price of gold goes up, there's more and more deliveries being requested. 2020 was the biggest delivery requested year for gold by far. And so that's only going to continue. And so you get yourself into a position where you risk collapsing the entire paper network unless you just close out those shorts and take the losses. And so looks like that's what they're trying to do, which will be a main driver of gold going up this year. With silver, different story, more of a supply and demand story of the mines that are producing silver. A lot of silver is produced as a byproduct of other commodities, and so as the cost of commodities goes up, as supply chain crunches, as the demand for silver goes up, especially due to some green initiatives, solar panels, things like that, there's just simply not enough new silver coming onto the market to meet the demand at the current prices. All right, now number 7, the thing that I expect to happen this year, and this is something that you're not actually going to know notice that much unless you're looking for it, is a continuation of de-dollarization globally. And this is something that has been going on for years, but especially people in the States don't really hear about it or know about it because nobody in the media wants to talk about this. But it's been happening, and it will continue to accelerate as the value of the dollar declines, as it becomes more apparent to the world that the dollar is the dirtiest shirt in the laundry basket. It's not, it's not something that the world is using out of desire. They're using it because they have to until they can get rid of it. And so we're seeing more and more countries start to do trade deals with each other that are denominated in other currencies outside of the dollar. You're going to see more and more of these kind of things happen until what I expect to happen is that over the next couple of years, dollar reserve status just continually declines until it's, I don't expect to see a big instant collapse where the world just instantly stops using the dollar. I don't think that's really as close to reality as some people think it is. I expect more of a slow decline. And if you look at the status of reserve currencies over the last, couple of hundred years, what you notice is that the official reserve currency and the official money stays in use officially a lot longer than it really is. Black markets take over, new money takes over, other countries take over, and the status quo is kept up as kind of like the emperor has no clothes type of thing, where people just kind of go along with it, even though everybody really knows that everybody uses a different form of money as their store value or as the pricing of goods and services or assets. Now, the eighth thing that I expect to happen during 2021 is another bubble in Bitcoin. And I say bubble very, very specifically because I don't think we're in anywhere near any sort of a bubble right now. What you have play out with Bitcoin, and a lot of you probably know a lot more about this than I do because Bitcoin and cryptocurrency, it's not my area of expertise. And so with that being said, what you tend to see happen with Bitcoin is that every 4 years it has that, the halving, the new supply of Bitcoins that are being given as rewards to the people who are verifying the transactions on the network. That's where the new Bitcoins come from. Every 4 years, the number of new Bitcoins that are being released as reward to these verifiers, it gets cut in half. And so the supply and demand dynamics change drastically from that. So every time that happens, you have kind of a supply crunch really, and it gets harder to get new Bitcoins in possession, meaning it's more expensive. And so that presents a momentum where it starts to drive the price up, which then catches public attention, and then you start to have a bubble develop. And so if we see any sort of a replay happen in Bitcoin during this, from the last halving was in May of 2020, May of last year, so been about 7 months. If you see a repeat of the last 2 times that this has happened, you would see Bitcoin multiply from the point of its halving in May. You would see it multiply anywhere from 30 times to 70 times within a year and a half from the halving. And so that would put Bitcoin anywhere between 250,000 at the bottom to 600,000 at the top. And then you'd expect a crash after that from, about a 60 to an 80% crash after that. And so I actually expect Bitcoin to hit at least 250,000 at the top of its kind of bubble. And it would happen during this next year as long as these dynamics continue to play out the way they've played out before. And even an 80% crash, which would be in line with the biggest crash from top to bottom, if that were to happen after the smallest rally, the smallest bubble, which would be about a 30 times, if you go from 250,000 and you have an 80% crash there, it would land you at about $50,000. And so you're at the current prices of about $30,000 per Bitcoin. Your risk to reward is not quite there right now, just from where it's at right now to the bottom after the crash, after the crash that would happen after the bubble. But still, I expect that Bitcoin will form these bubble dynamics. Another FOMO rally will happen. A bunch of money will dive in, and we'll most likely have another crash after that. All right, number 9. The 9th thing that I expect to happen this year, this might come as a shock, but I expect that the Federal Reserve will step in and start buying stocks. That is right. We saw during 2020, the Federal Reserve overstep its congressional limits and start to do things that by law, it's not technically allowed to do. And they did this using special purpose vehicles, which was the same thing that Enron used to perform accounting fraud. But when the Federal Reserve bought high yield bonds through ETFs, they were actually overstepping their legal limits, and Congress did nothing about it because they were like, hey, we need you to do your thing. We don't understand it. We need you to rescue some stuff, and we need you to keep the game going. And so they were okay with it. And so by all measures, it looks like if the Federal Reserve needs to do something to extend the bubble, to extend the game, to keep the ball rolling as long as possible, even if it sacrifices the purchasing power of the dollar, Congress will let them do it. And so I think the next stage of this happening is the Federal Reserve actually purchasing stocks, and they'll probably do this through purchasing ETFs, shares of ETFs. But what will probably prompt this is that we're probably going to have some sort of a FOMO euphoric rally in the stock market. I would not be surprised at all. And I want to preface this by saying I actually don't have any hard expectations on what the stock market is going to do this year. During last year, I was at the beginning of the year, I was bullish on the stock market. You can go back and watch all my videos if you want to. It's all documented. I don't delete any of my videos. But during the beginning of the year, I was, saying, hey, it looks like we're having a melt up. Then, coronavirus happened, and I was saying we're probably going to have a crash. And I was expecting more and more of a crash until, after the bottom. The bottom happened in March. It was somewhere in April when I changed my tune and said, hey, we're probably just going to be going up from here. And I said, more and more and more. And 3,800 was my price target on the SPX. By the end of 2020, we came within like 45 points of that, like 37.56, I think, is what we closed out on the last day of 2020. So this year, though, I don't have any hard expectations on what the stock market will do. I would expect. My conviction level isn't very high on this, but I'm expecting that we'll probably have some sort of a big euphoric rally. We're going to have FOMO. We're going to have a bunch of money dumping in, and that will be the end of it. We're then going to have a giant crash. And then once we start to have a crash from there, I think that's when the Federal Reserve will step in to purchase equities to keep equity prices up, because equity prices being up is what's keeping, a lot of these companies solvent, especially with the relationship to the debt and the over-leveraged economy that we have. And so they'll recognize the need to bail out the equity markets. Since they've already done that with credit, they couldn't step in anymore there. So they now have to come in and start purchasing equities. So I think that will probably be something that we see happen this year. This leads into the 10th thing and the last thing that I expect to happen this year, which is kind of going to be one of the drivers behind the stock market kind of melt up that I think we'll probably see this year, is universal basic income really just gets cemented. And they'll be called stimulus checks. They'll be called, bailouts for the poor. They'll be called COVID-21 checks, whatever you want to call them. I don't care. Whenever you have easy monetary policy, it becomes more and more difficult to go backwards the further you go in. So every time you ease monetary policy, it makes it harder to tighten. And printing money and just sending checks to individuals is a big step forward. And we had that last year. And from the start, before they had even passed that bill, they were talking about the next time that they would do it. And so there is this mindset by the entire country, left and right, and all politicians that, at some point we need to continue to send more checks to people. And so this kind of thing, when this starts to happen and people become reliant and dependent on that, it's almost impossible to back out of. Look at any historical example where the governments start just paying for individuals' expenses. It's very, very, very difficult to pull back from that, to the point where if you do, it actually does cause pain, because that pain existed. And so if you swallow that through money printing and then try and release that pain back out onto the economy, it does cause destruction, economic destruction. And so the only way to continue forward is to continue to print more money. And so I think that we're going to see more and more, and we're going to see that this year, really, universal basic income just becomes something that is normal, and people just continue to get new checks. This is going to drive asset prices so much higher, because contrary to popular belief, handing out checks to individuals is the most inflationary thing that you can do. If you print a bunch of money and hand it to a bunch of rich people, that's corruption. It's wrong. I get it. Doesn't really cause as much inflation, because what do those rich people do? They buy assets. They're not going out. If you give one person $1 million who's already rich, they're not going to spend that money on groceries the same as would happen if you gave 100,000 people $10,000. You give 100,000 people that are just, regular average income, low income, poor people, $10,000. Instantly that money is going to be gone. And that is incredibly inflationary. When you start seeing these dynamics unfold where money goes directly into the hands of people, then you start to see inflation. And so either way, the rich get rich, because when people start spending all this new money, then that drives prices up. When prices go up, that drives revenues and earnings up. That makes asset prices go up. And so either way, the rich are going to get richer here, and it's going to leave the poor worse off because the cost of living goes up. And so you're getting yourselves into a dynamic that you really can't pull yourself out of, and ultimately leads to kind of a currency collapse. So those are the reasons why I'm incredibly bullish on gold and silver and miners and Bitcoin this year. And I expect to see more and more control, more and more handouts happen all throughout the year. And through the use of yield curve control, through we're going to see higher inflation, higher than the 5 to 10%. I don't think it'll show up in CPI. I think we're going to see the Federal Reserve absorb the credit markets and really nationalize all of the banks, even if that's just kind of de facto nationalization and not officially. And I expect to see commodities up big, and that the Federal Reserve will start buying stocks, and that universal basic income will really become cemented and become a normal everyday thing that just continues to happen, and really there will be no end in sight for it. Now, these things I think are bad things. I don't think these things are good for society, but expecting that these things are coming, there's an opportunity to massively increase your wealth if you expect these things to come and you invest accordingly. If you like to invest in gold, silver, or Bitcoin, and you haven't done any of those yet, I've got all of my recommended resources who I use to invest in gold, silver, and Bitcoin linked in the description below. As always, I really appreciate you guys. You're the best. Have a great day.